Make no mistake, institutional traders run the markets. These are the big money players, outfits like Goldman and Sachs, JP Morgan, BlackRock, and State Street. They are sharks, giant financial sharks. Now here's an industry secret. Institutional traders don't trade like you and me. They attack the market in various ways, including high frequency, time-based, and fundamental strategies. Now in this video, we're gonna show you a few tricks on how to capitalize on institutions' actions. All right, let's get to it.
An institutional trader is an entity that moves the markets. These people place trades for hedge funds, pension funds, governments, corporate interests, and banks. Institutional traders do business on a large scale. That's their single biggest advantage over the public. They have more money.
The cardinal rule of the markets is this: the big money always wins. Now you cannot beat the institutions. They have too much money. This money gives them the ability to weather storms and ride out market noise. Your only chance is to join them. Now there are countless ways of doing this. We're going to focus on two of the most powerful. We're going to learn fundamentals and we're going to understand institutional technicals.
Okay, the first institutional trading strategy that we're going to talk about here is the fundamental trading strategy. Now, at its core, what the fundamental trading strategy is, it's the search for intrinsic value. Okay, let's define intrinsic value. The intrinsic value of a business or a security is its inherent value based on its future cash flow, risk, and growth potential. Essentially, what intrinsic value is, it's the true value of an asset. Now, there's a lot of different things that figure into that. We're talking about economic cycles. We're talking about definitely monetary policy. We're talking about actual earnings, PE ratios, things like that. Fundamental traders typically have the deep pockets. They're looking to get in on something before the rest of the world knows what it's worth. That essentially is getting in on a consumer trend or a market trend before it ever shows its face on a chart. Remember this, fundamental traders typically don't use charts. They're in the search for value. They use other tools. I'm going to show you two right now. Now, if you're a Forex trader, a fundamental Forex trader, it really gets no bigger than the CME FedWatch Index tool. This is a derivatives market that prices in the interest rate expectations for the United States dollar. This is the market betting on what they believe the Fed's going to do. If you've watched any of my live streams, then you definitely are familiar with the CME FedWatch. So right here, you can see in the near term, when the meetings are close, we have a pretty good idea of what's going to happen. There really isn't a whole lot of mystery a day or two before the meeting. We know what interest rates are going to do. Now remember, as interest rates go up, that United States dollar strengthens. That's going to send a lot of that action through the Forex and maybe prompt somebody like an institutional trader that has the deep pockets to go on the prow for carry trades, where they're going to play the US dollar against another currency for an extended period of time to get in on that appreciation. Now, the converse is also true. If, in fact, the FedWatch is telling us, hey, maybe we're expecting rate cuts, then we can go ahead and maybe make a play against the U.S. dollar and hold that thing for 1, 2, 3 quarters, maybe even years, depending on your economic cycle. A fantastic example of that was COVID-19. There was a lot of institutions playing for the U.S. dollar initially and then against it starting in about, 2020, second half of 2020. So a lot going on here realistically with the FedWatch. One thing I want to point out, though, in the near term, it's easy. We all pretty much know what's going to happen. But in the deferred term, maybe 2 or 3 quarters down the road, take a good look at this. It turns into a bell curve. A lot of uncertainty there. And where there's uncertainty, there's definitely opportunity. Now, a lot of stock traders out there, this is just a textbook. Ran a quick Google search. If you're looking for intrinsic value in stocks, go look no further than your reports, your annual reports, your quarterlies. That's going to give us a good look at the financials, the inner workings of the company, and we can try to figure out from there if something's undervalued or overvalued. A lot of this has to do with ratio analysis. We honestly could do a video on each one of these items. The big thing to remember is are we beating expectations or are we not satisfying what the Wall Street believes we're going to see out of these companies? So take a good look at this. This is a good look at NVIDIA. They've been beating expectations for a long time, and their stock price shows it with just a tremendous rally over the course of some incredible financial performances. So that's two ways that fundamental traders look at the market. They have deep pockets. They don't necessarily use charts. Forex fundamental traders are looking for interest rate trends, and stock traders are always looking for those internal financials that potentially could drive growth and potential value. And remember, what is fundamental trading all about? Intrinsic value. Okay, let's take a look at some technicals. Okay, the second institutional trading strategy we're going to talk about here is technicals. Now, full disclosure, many institutional traders, or if not most, don't even pull pricing charts. They don't look at them. They want that intrinsic value. They want to get in on a consumer trend or an economic trend before it even develops. They want to be in the markets because they know something that no one else knows, and they have an opportunity to capitalize on that knowledge with a lot of money that gives them the staying power to hold in there through the peaks and the valleys of the market. So there are some technicals, though, that institutional traders do look at, and we're going to go over two strategies that they employ fairly regularly. And if you have the staying power and the cash to make these trades, they're relatively straightforward. It's just not many people have the money to trade like the institutions do. The first one that we're going to look at is the Golden Cross. Now, the Golden Cross is a bullish strategy. We've covered a lot of crossover strategies on this channel. Feel free to check those out for short-term traders. But the bread and butter of many of these institutional traders, investors, 50 to 200 SMA. When the 50 crosses over the 200, it's a signal to buy the market. This is done on the daily time frame. This is a longer term type of a trade, but take a look at how it panned out for you in 2024's gold market. Right there, we had a crossover that goes back to about the 5th of December 2023. There, your 50 crosses over your 200 and you're off to the races. You're probably getting long somewhere right around $2,000, and where are you at the end of the year? You're up at 2,700, and these two moving averages haven't even begun to converge. So the first one's a golden cross. That's a tried and true signal to go long the market. That's when the 50 SMA crosses over the 200 SMA, and you just buy the market. A lot of institutions do that. A lot of long-term investors do that. And typically, the longer the term and the investor, the more money they have at their disposal. Now, the second one is going to be what? The opposite of that, the death cross. Your death cross is going to be a bearish type of a strategy. It's when the 50 crosses under the 200. And you can see right here on this Euro USD daily chart, realistically, that 50 crossed the 200 somewhere right there in November of 2024. And we've really seen sort of I would say price definitely has taken a turn to the bear. The real question is does this market make another leg down, or does it recover? Now, a lot of institutional traders would say, well, the 50 crossed under the 200. I'm going to go ahead and go short somewhere down in here. And if in fact that's the play, and many have made that play, they're probably looking for something like par value to be a potential target. So remember, the technical side of the institutional game, it's not quite as involved as the fundamental part of it, just because we're looking for trends, big moves in price, because the institutions have the money, the staying power to ride out the peaks and valleys in the market. Now, we've made a lot of videos about other strategies that are used by institutions, high frequency traders, intraday traders, things like smart money concepts. We've got a ton of those videos on this channel. Be sure to check them out. We also did one on key levels. That's a big one. The key level video will show you exactly where the clusters of orders can be from the institutions, and then also the liquidity sweep video. That's another good one. Check those out. Those are also other ways to go with a shorter term approach to institutional trading. But I have to say that the Golden Cross and the Death Cross are two of the most common technical strategies used by institutional traders.
The institutional trading strategy is simple. Follow the big money. Now, this may be done in a myriad of ways. We have several videos on the How to Trade YouTube channel that teach you to do just that. We've got the Beat the Market Maker strategy, some smart money concepts, and key levels. Those videos are just a few that can help you follow the big money. Now, we put these strategies to work on our live streams on a daily basis. If you haven't checked out a live stream, head on over to How to Trade and check one out. Now, remember this, sharks don't eat sharks. You're a little fish. Learn how to follow the sharks and ride their coattails to the bank. All right, that's all for now. Like, subscribe, and we'll see you on the next one.